Hi, it's Jeffrey Cohen, Chicago Quantum. How are you? Just a quick video to talk to you about where we are with our managed hedged fund. I don't know that I'd call it a hedge fund. I would call it more of a hedged managed account strategy. And hopefully you find value from it. Some of you may eventually invest in it, but really it's giving us a lot of education. It's really showing us kind of how the market works, how important expectations are. And so I want to walk you through a few things I saw today. I haven't made a video in a while, and so some of these thoughts I may be a little out of practice, right? That's kind of where I want to go with it. So what I want to do is I want to show you, we're so long Corbis. We've been long Corbis for over a year. It is a long-term holding for us. And just to show you what's going on with Corbis, if we were to look 5 years, so we got in when the stock had dropped to about $1. Probably started buying at $1.30, maybe even $1.50, and we've been buying all the way down to zero. And so the stock is now at $12.59, which is actually an up day. And you know, when you have positions like this, it just changes the way you think of the market, because you realize that anything you buy, you could lose 90 to 95% of the value. It just is what it is, right? And so there's nothing magical about stocks. There's no inherent value. There's just the value of the next person who bids for that next share. And so let's move that out of the way. So I just again want to show you. So this is Book Viewer. This is the book, except for the very top of the book. It's a level 2 book for NASDAQ. And the way you look at this is you say, all right, who's trading it? Let's make it bigger for you. We're just going to look for the buy side. So you look and you see, there's FLTG is actually a supplemental liquidity partner, so they don't really count. So you guess someone's willing to buy 200 shares for $25. Oh look, $400 came to the market. $600 at this price. So not much. It's cool. I'm not expecting a miracle here. So the supplemental provider is now top of the book with 100 shares for a whopping $12.43. Now we look at who's selling, and you also see tiny, tiny sell orders. $100, $50, $13. Wow, we're up to $500. And so the real question is, Jeffrey, why aren't you the master blaster getting in here? Buy a couple 100,000 shares. I mean, I love the company. Why not do it? And the reason is I have so much money invested in the market, and I have so much kind of like my risk profile that you end up in Corbis and you just have to watch, even though you know it's cheap. You just have to watch. There's no 100,000 shares I'm going to buy in the next 5 minutes. It's nothing. I don't even want to buy 100 shares. $12. I just want to wait. Because who knows what's going to happen, right? Because at every point since we've been following the stock, there really hasn't been a good time to buy. It has always been a loser. And so, that's a stock that we love. That's a stock that it's funny, right? But this isn't managing a fund. See, this is playing games. So I want to talk about what it looks like to have a fund. So what happens is you go through the process of setting up a model portfolio. I finally understand now what this is all starting to look like. So here's our model portfolio right now. So for those of you who are really quick with doing screenshots and you want to copy our model portfolio, God bless you. Go ahead. It's a lot of work. It's getting up early every morning. It's figuring out what you're going to do. It's making all your trades. It's thinking and talking about it. It's the accounting side of it. And then in the evening, it's running your quantitative models, figuring out all your key assumptions, and then deciding, do I like what I'm seeing or should I run something different, right? So you do the coding, you run the models, and then you look at the answers and you say, And sometimes it's a little dangerous, but you wait a day. It might say, hey, buy the stock or sell the stock or buy 30 stocks, right? And hang on now. Can't have too many transactions. So let's just go a little slower here. And so here's our model right now. And I want to show this to you because there's a lot of movement that happens. And so we ran our model and we didn't change much. We changed the risk-free cost of capital. And we ended up changing back the expected return that we expect from the market. And the reason that we turned it back was we didn't like the size of the change. So these are sells. So that's a lot of sells, by the way, for us. And these are buys. That's a lot of buys for us. So 5 stocks hold. 7 stocks sell. 15 stocks buy. At the same time, so you see what kind of stocks that we bought. We bought VMware, we bought Qualcomm, we bought Microsoft, Intuit, we bought European Waxing Centers, Amazon, Apple, BlackRock, and some other stocks. It's hard to know who they are. And you see these are the betas right here. The betas are much higher for the stocks that we're holding than they are for the stocks that we're buying. And so actually the betas dropped significantly lower. I want to say it's 1.34 average. And before it was like 2.2. So what happens is we have 2 different ways to hedge using the S&P 500, and we very, very much like this one. This is the one that we're deciding to go with. It's a beta of the stocks that we hold, weighted average beta, not straight beta, weighted average beta of the S&P 500. And we use a spider. We don't have to use a spider. We could use a future or whatever. But for right now, we use a spider because our stock trading partner doesn't, we don't trade futures on the platform. So we trade stocks, and that means stocks and options. And that means we trade the spider. And so yesterday we had 29 hedged, and we had 60 hedged for the beta weight. What's interesting is we added a lot of money, but yet only had to add 2 shares. So our straight edge added 17 shares of the spider. Our beta weighted added 2. So the net of it is that there's a lot less hedging. Relative to the density of the longs. Like the hedging density is smaller because the beta is smaller. Less risk. Now you look at who we're shorting. Now the top 5 stocks that we should be shorting is Desktop Metal, Board Drilling, Grab, Snap, and AMC. We just today had 3 sells. That's a lot of movement. And we had 1 buy. And so we bought back all of our Desktop Metal. And the reason we did that is we actually did a little bit of homework, and it kind of looks like a successful company. And so even though our model has had us be short Desktop Metal, and we've actually made a lot of money on that position, we switched. So Grab, Snap, and Bohr. Bohr looks a lot like a meme stock. Snap is just a dying company. And Grab, I don't even know. I couldn't even tell you what's going on right now. But so we have 3 positions, and those balance at the open. It was at 17,500, and we were at 17,300 for our long. So that's effectively a 1-to-1, short to long. So you run this fund, and what happens is a day like yesterday comes, which was quite traumatic for us. It was a traumatic day. We had very few longs, right? We only had 12. The beta weighting was over 2, so this is yesterday. And our longs lost $183, 1.7%. Now, this is a paper traded model portfolio. So 1.7%, $183. If it was a multi-million dollar fund, you just add some zeros, right? Our hedge, we would have made 224 on the beta weighted. On the straight edge weighted, we would have made 108. So we made money beta weighted hedging our portfolio. So what that means is the stocks as a group went down less than the beta weighted S&P 500. What's interesting for us is our shorts only moved by $10. And so we lost 183. We didn't really make anything. So we lost money. And that's what's been happening lately is our downrun stocks have been going up or staying flat during the latest part of the market. So I want to talk a little bit about this. I've been really trying to figure out why this is happening, right? And where do we move going into next week? So Friday, today, you can see we had a lot of buys and a lot of sells. It's kind of crazy how many we had. Look at all those transactions. Those transactions cost money because there's a spread. So they don't cost us money like a commission, but they cost us money because of a spread. In fact, 2 of them, the spreads were so high, we ended up having to go back afterwards and make the trade when the market kind of closed up. So that was interesting. So this is our model portfolio. It has made money most days. It's great. Not a lot of money, but little. It's not bad. It's not bad. And this is why we're going to offer this to clients, because to do this work, it's a lot of work, but it does generate positive returns, even in a market that is choppy to down. All right, Chapter 1, our model. Chapter 2, I'm going to talk a little bit about stocks and what we see and what we publish on our website. And so this is all on our website. So where is this? This is, we'll duplicate, go home. Chicago Quantum, registered investment advisor, consulting firm, desperately looking for clients like you. It'd be great. Unfortunately, if you want our consulting services, you could be anyone, right? If you want our investment advisory services, you have to be high net worth, institutional, wholesale banking. You have to be kind of in the business. You can't just be an individual, because as an individual, it's really hard to understand the risks and returns of pretty much all of our services, except for we have some family planning, financial planning services. Those I think anyone can use. But if you want to use coding and you want to use trading and things like that, you need to be those special people that have a lot of money and who can afford to maybe put 1 or 2% of their money in to get an asymmetric risk profile that makes money, and we can dial it to make, through our hedges, to make or lose money during an up or down market. And so I need, hang on one second. This is Jeffrey Cohen, Chicago Quantum. How may I help you? Okay. Absolutely. Okay. Right. Oh, that's great. So I understand number one, number two, number three. How are you doing, by the way? Just to catch up on that.
Well, quiet. And I still feel a tightening around my chest. I still feel that.
Mm,
Maybe the brain catch my breath a little bit better than I think. But I mean, I still feel a little sore, but not sore, but like in my
like,
stomach.
like in your neck.
Yeah, like on the
Ugh,
back of my neck a little bit. But my
okay,
neck feels fine. Everything
okay.
else feels fine.
Well, you should know that I love you, and that I'm thinking about you, and I'm really looking forward to you coming home. I think that's terrific. And then we will plan to exercise indoors.
Okay, sounds good. Oh, and then we'll scan the ladder. I'm gonna have to look at the phone before we
Absolutely, we'll take care of that. Thank you. I'm glad you're feeling okay, and we'll see you soon.
Yeah, I'll see you soon.
All right. Okay. Bye bye. Love you. All right. That was Mrs. Chicago Quantum, and we have some very serious health issues in the house, and so we're making that a priority. I'm sorry you had to hear that as part of the video, but you know, we're here. We're here. We're working hard, and we're doing our best. So, and the good part is, I'm able to make the trades, and I'm able to run the model, and I'm able to manage the model portfolio, and I'm also able to get the daughter to work, or daughter to school every morning, and that's nice. I get up early, make sure she's having a good life experience, basically. So I want to share a few things. So on our website, you can see we have this alternative investment opportunity. You can only access that page if you've been vetted. Then we have stock market quantitative analysis. These are what you would buy if you wanted to buy some services and not actually have us run money for you. So if you wanted to buy our up run, we run this every night. We can run a special run for you. And we can cultivate it, right? And so I love it. I love what this is. I probably should go through and make sure that you actually receive everything it says you receive, and that there aren't other things that you might receive that you don't know about. We've added a lot to the model, and so we should probably go through and check that, right? Now, the other thing we publish is we publish a lot of market information and research. So market information, we publish negative beta stocks, top dividend stocks, leptokurtic, platykurtic, high and low beta stocks, positive negative skew stocks, high and low volume stocks, stocks that have fallen in price, stocks that have traded a lot of shares and have prices have spiked up or down, and stocks that have split this year. This is all data that comes from our model. So the only thing I have to do is do my job and then copy and paste everything on the website. I'm sure I could probably automate that, but I don't know how. So I'm not really a programmer at the end of the day, especially not a web programmer. More of an infrastructure guy. I used to design major data centers for large banks and help with the data center infrastructure and all the servers and the storage and the networking. Big, $1 billion IT budgets. So now I have my own little IT budget. It's very nice. I like it. So today's insights. This thing about variance is the thing that we're probably focused on a lot, at least online. So if you look at the stock price variance, the variance of price changes has begun to rise again. Now, you can see this, and this is where, by the way, we're losing our butt with our personal investments in the stock market. We're down to having about 6% of our net worth in the stock market right now. It's not much. And half of the 6% is passive. So we have 3% actively traded trying to make some money. And that 3%, we're doing so badly now that I want to cry. Okay? But it's okay. I'm not going to starve to death, right? I mean, it's going to be fine. But we're losing a lot of money, and we think we're pretty smart, and we feel like we understand things, and we hope that we're making good trades, but truthfully, we're not really. What happens is you see a market like today where it's down. It actually opened up, then down, then up, then down, then flat. Now it's up into the close. 15 minutes left for the close. Who knows what's going to happen? I don't. If I were to go and pick a different one, let's take the Yahoo Finance, S&P 500. By the way, our models makes money. That's the funny part. If I just put the money in the model, I'd have made money. I'd have been okay. But I didn't. It's really hard to run a fund, by the way. And so what I realize now is it just takes time. You have to understand what you're doing. You have to give it time. You have to learn the lessons. And so this is the S&P 500. And so the reason that I'm showing you this is because I want you to see that it has done this gradual rise and a gradual fall. Not a big surprise. In fact, I bet you I could draw a line and I can show you from here to here. So we're back at the point where we were December 2020. So I don't know. You could imagine all the ups and downs and trying to capture them, but truthfully, your money's kind of flat since 2020, right? And so this is what it is. We keep betting on miracles, and they're not necessarily happening. When you look at the stocks that our model holds, AMD, BX, right? Those are big names. Nvidia, big name. But then you got some risky ones. You got Q-Rate Retail. You got Rocket Mortgage. Then you got like Apple, Amazon, BlackRock. And then you have European Wax Center. You have State Street, Qualcomm, and then you have a potash company and Intuit. Small companies, right? We used to hold UEC. So and Wingstop. It's not just large caps. It's not just small caps. It's a blend because they tend to move in the appropriate way. These are actually our shorts. Let's take a look at those. Where'd they go? That's funny. I lost them there. So our shorts in the model is BORR, which is down 3%, Snap, which is down 1%, Grab, which is up 0.5%. So our shorts are making us money today. Our hedge against the S&P 500 will lose money today. I'm always interested in following the banks. Banks are up. And interest rates are down at the short end, up at the long end. It's interesting. Who knows what's going to happen there? So a lot going on. But what I don't understand is with all this movement, I don't really get where the market's going, right? I know the long-term trend is down, but we don't know. That's what makes it so interesting. If I stay focused on the model, the run, the answers, if I focus on the up run, which is this is the output of our model before we produce it into a pretty report. It's probably enough for most people. And you can see the portfolios that it chooses. These are the best 5 portfolios. They have mostly the same stocks, but in fact, they have some different stocks. Now, this one is from October 24th, so don't quickly go and grab that. October 24th. Let's shut that one down. I don't even know why that's open. Ooh, we got lots of them open there. Bring all to the front. That did not work. Where are they? All right. I need a minute, guys. I'm gonna show you the most current run. I think that might have been it, but I'd rather just shut them all down. Reopen. I have no idea why it's doing that. That's so funny. And they've all got the same Control F search saved, so I can't even tell if that's it. Good. Give me a minute. November 3rd, run, up, text, go. This is our most current run. This ran last night at 5:15. Took a few hours, not too long. We have some data issues here, which I never like it. I actually sent those to the data provider. Normally, we have a bunch of stocks without a market cap because either A, they're brand new stocks. They haven't traded very often. Where'd it go? Didn't trade very often, like Qubits, because that's a brand new SPAC, right? Lumen should have a market cap. FCX, Freeport McMoran should have it. KKR should have it. Meta should have it. So the question is, why not? Qubits I get, and there's some banks in there, right? So I don't know. For some reason, some of them did, some of them didn't. So yesterday's run, a little suspect. Not too bad. And you see the variance there. 0.000246, or 2.5 times 10 to the negative 4. And what happens is when we look at the stocks that we are tracking, that 2.5 times 10 to the negative 4 for profitable stocks is the highest that we have ever seen. And during the time when the market was going up and everything was awesome, that number was 1.4. So 2.5. So it's gone up 70%, 65%, 2/3. So the variance or the movement of the stock prices is up by 2/3, the variance. Now, if we look at stocks with negative net income, you see that used to be 4.3. Last time we typed it in, it was 7.3. And I believe, just going off of memory, it's now 7.22 or 7.25. It's close. Probably worth a quick look just to make sure that we're not blowing smoke up your ass. Nobody wants smoke. The variance is 7.23. That was close. So, with that said, so it's actually gone down a tick. So what that means, though, is that now we look at the S&P 500, and this was at 2.1. And it's still 2.1. So stocks and companies that made money have more variance, but all stocks have more variance. And stocks that lose money have tremendous variance. And so I think about that. I think about the amount of movement, the amount of options premium, right? The amount of change, the amount of riskiness in every investment that we make, right? There's more risk. So why would you invest quite so much money? Why would you do it? There's more risk. So I don't know. I don't know why you do it. I'm not sure you do it. I'm thinking maybe you stay home. And the reason that I say that is because if you just buy regular old stocks that are profitable, good stocks that your grandfather, grandmother told you to buy, right? AT&T, General Motors, right? Companies, oh yeah. You got a lot of risk, 66% more risk. How about some high flyers, not yet profitable? Twitter. Let's go buy Twitter, Jeffrey. Go buy Corbis. Well, those risks used to be 4.3, and now they're 7.2. 2.9 out of 4.3. That's about 60% additional risk. And if you said, you know what, I'm passive. I just want to buy the S&P 500 at 1.2. And now you're at 2.1. That's 75% more risk by holding the S&P 500. To me, that says we're in big trouble. because stocks are moving too much. And a regular investor, not a speculator, but an investor, they don't want that. And so what's interesting about our fund and our managed account is that we're not saying that AMD is a great stock or BlackRock, right? Or NVIDIA or Q-Rate or Blackstone, I should say. BlackRock, Blackstone, any of these. We're not saying they're great. Earwax, European Wax Center, Qualcomm, VMware. I'm not an expert. I'm not going to tell you that VMware has got a great software product and the IT industry is going to be buying more of it. I don't know. Honestly, is what it is. But what I can say is if you held all those together, the holds and the buys, you're going to do better than the S&P 500 with the same beta weighting. How much better? A couple of percent a month, maybe 2-3% a month. That's pretty good. And when the market flattens a little bit, you might make more. And sometimes if we think the market's going to go up, we might dial back the hedge a little bit. But it actually has a natural dial back because the less movement, sometimes beta changes. We've noticed days where beta changes for pretty much all the stocks. And so it's just interesting. And this is a way to put money to work in U.S. profitable companies, which is where you want to invest anyway. But it's a little bit smarter. That's where we're going to be putting our money, actually. Not in Corbis. It's crazy. God, Corbis. Who the hell buys Corbis? Let's look at it again. Who buys the stock? I must need my head examined. This is the stupidest stock in the world for anyone to buy. It's a zero. It's a zero. I own a lot of it. Maybe I'm the zero. But I will say this. I don't think the stock's going to zero. I think the stock's going to $1. And at $12.50, $12.75, 12 and a quarter per share, goes up to $1. That's about a 700% profit. So I'm in. I'm buying. I will probably buy more of this stock soon. But this is risky. This is a lot less risky. This is risky. Corbis? It's crazy. Look at that. The liquidity provider has 2 100 share orders in to provide liquidity. What's going on with this stock? Nobody wants to buy it. Nobody really wants to sell it. What, 2,000 shares? Nobody wants to trade it. It's a zero, right? So this is what we do. And so as we head into the close, let's see how our fund does. Let's watch it into the close, right? I like to do this sometimes. So into the close, you see that we will make a little money on our shorts. We'll lose a little bit of money on our S&P 500 hedge. Personally, you see where we're at. Corbis up almost 5% is a very, very good thing for our worth, for our net worth. It's terrific. Where are the other stocks? Come on now. Long portfolio. Here we go. They're all even, so you can kind of do it this way and say 1, 2, 3, 4, 6, 7, 8, 9, 10, 11. You should be right around +1, +1.5%. Unfortunately, one of the positions is down 23%. The other one's only up 5%. So figure you made 0.75%. The shorts, you made some money again. So maybe you made 1.25%, 1.5% today. Now the S&P 500 hedge dropped a little. So if it was just longs versus S&P 500 beta weighted, maybe you broke even, maybe you made $100. If it was longs versus shorts, you made good money today. And so what we find is it's a little more risky to do longs versus shorts than longs versus S&P 500, but you can see it here. So we'll do a quick look. Now I'm assuming that the market closed now and not in an hour, but let's just you can see it. And you can see Q rate is down. And so we don't trade during the day. We don't rebalance during the day. We let it run. We let it run. And so for Q rate, tomorrow morning, if it's at this price, we're probably going to have to buy some more because we can't have one stock being 20% smaller position than all the others. So if our model says to keep it, we keep it, we bid it up. Now the reality is the model probably won't say to keep it because it'll have had a big move. Maybe it's had a big move over a couple of days. Maybe it's moving counter-cyclical to the S&P. So if the S&P's up and Q rate's down, that just slammed out the beta, took out some of the beta correlation, which means maybe it's not such a good stock for us. The expected return is lower. It doesn't move with the market. It doesn't have as good of an expected return. So that's interesting. Take a look at the other pieces. Look at the hedges again. You would have said, oh, Jeff, you did okay. S&P 500, right? 0.8. So we're going to pay back that 0.8 or 0.78. And we're going to make money on the shorts. A third in each. So, all right, well, we take a look. You know, the S&P 500 is actually falling, which is interesting. So if it falls by three down to 371, we'll break even on our hedge. It's kind of interesting, right? You don't know what's going to happen. You don't. All you know is that you've got a bunch of longs which are now working together pretty hard. And we'll see how they do. And so, you know, you end up with one really bad stock, but at least they're not all bad. It's only one kind of bad. A couple others are negative, but for the most part, it's a positive story today. And so, yeah, we might do okay. We might make some money today. So that's it. That's what we do. And so what we're actually doing right now is we are calculating our fee structures and we are documenting our business processes, how we do business with clients, so that we can give that to the SEC, give it to FINRA, post it on our website, and that you folks can read it. You can understand the terms and conditions of working with us. So, but for right now, you can still go to our website and you can still buy a run. You can still understand, you know, how we do business and how we think about stocks and all this market information, all this research that we do. You know, there's a lot of data there, right? And so you get that if you buy a run from us. If you look at the services and you decide that a run is too expensive, we did have one person ask us, you know, what if this is too expensive for me? And you say, all right, what's $750 for a long run? Maybe we work something out for you. I'm not going to say you get everything for a lower price, but if you can help convince me that maybe your value prop is smaller, maybe we do something custom for you. I'm okay with that. Just reach out. And the way you reach out is you go to contact. This is me. You can see I put a nice suit on. I look nice. You know, there's my cell phone number. There's my email. Here's how to reach us. You take care now. Thanks for watching. If you like the video, we're not paid to make the videos. I'm actually just making it for you. Hit the subscribe button. Maybe shoot out a tweet or throw it on LinkedIn or Facebook and say, hey, I saw this great video. Guy's starting up a fund. He's in Highland Park, Illinois. Registered. Good guy. Seems to know what he's talking about. And share the word. What will happen is get some other people to watch. And if we can get to 1,000 subscribers on YouTube, do you know that they could send us 50 cents a day? Possibly even $1. And with $1 a day, I can buy 7 shares of Corbis every day. And maybe that's what I do. Maybe if we can get 1 million subscribers and I can get $10,000 a day, I would promise to invest every one of those dollars into Corbis common stock, at least between now and a potential reverse split, which is going to happen in December. So, you do something for me, I do something for Corbis. Think of it as like a not-for-profit, because they don't make money and they're trying to find all these great drugs. So, all right, thanks so much. Take care now. Bye-bye.